What happens when a $30 trillion economy tries to stomp on an alliance it underestimated? You get supply chains bleeding, US factories panicking, and something even more dangerous, BRICS nations smiling, because Donald Trump's threat to slap 150% tariffs on BRICS exports wasn't just bold. It may have handed America's rivals the one thing they've never had: leverage. And this is where things start breaking. If BRICS poses no real threat, why is Washington panicking over the dollar? If BRICS were just a symbolic coalition, the Federal Reserve wouldn't be modeling de-dollarization scenarios, and the US Treasury wouldn't be tracking bilateral energy settlements outside the SWIFT system. According to a February 2025 Bloomberg intelligence report, the number of cross-border trade settlements bypassing the US dollar jumped 24% year over year, driven largely by BRICS members and new applicants. While public statements from US officials still downplay BRICS' cohesion, internal memos reviewed by Reuters show growing concern about parallel financial infrastructures weakening the dollar's default status in global trade. Former IMF chief economist Kenneth Rogoff warned in a recent WSJ op-ed that fragmentation of reserve currencies won't happen overnight, but it rarely needs to. It just needs to start. But if the dollar isn't in immediate danger, why are US debt auctions suddenly requiring higher yields to attract foreign buyers? The petrodollar deal inked between Washington and Riyadh in 1974 made the US dollar the exclusive medium for global oil trades. This forced countries to stockpile dollars to buy energy, which in turn propped up US Treasury demand. But today, that system is showing cracks. According to Goldman Sachs, the share of global oil trade settled in non-dollar currencies rose from 2% in 2020 to 13.5% in 2024, driven largely by China's energy contracts with Russia and Saudi Arabia. Bloomberg reported in January 2025 that Saudi Aramco and China National Petroleum Corporation concluded their first Yuan-settled oil deal, valued at $7.2 billion. Former Treasury Secretary Larry Summers called this shift a clear structural break, warning that if the petrodollar era ends, so does America's low-cost debt advantage. The dollar's power was never absolute, it was contractual, and those contracts are now being renegotiated. So what happens when America's biggest export, its currency, starts losing global market share? The shift isn't ideological, it's defensive. After the US froze $300 billion in Russian foreign reserves in 2022, trust in the dollar's neutrality began to erode. According to a 2024 BIS survey, 56% of central banks in emerging markets accelerated diversification away from the dollar, citing geopolitical risk as their primary reason. In the Gulf, this shift is playing out in real time. The UAE's central bank signed a bilateral swap line with the People's Bank of China in December 2024, and Saudi Arabia's sovereign wealth fund is now holding part of its cash reserves in renminbi-denominated assets, according to a January 2025 report from the Financial Times. While the dollar remains dominant, its dominance is now conditional, and US allies are writing escape clauses. The Wall Street Journal quoted Mohammed El Erian, chief economic advisor at Allianz, as saying, "The risk isn't the end of the dollar. It's the beginning of options." But what exactly are those options? And how soon could they become viable? China's digital yuan has already surpassed $250 billion in cumulative transactions since launch, with $70 billion occurring cross-border per the People's Bank of China's 2024 year-end report. Unlike traditional currencies, it's programmable, traceable, and bypasses SWIFT. The Bank for International Settlements noted in its 2025 innovation report that China's ECNY pilot is the most advanced central bank digital currency in operational scale. Meanwhile, BRICS finance ministers are finalizing technical frameworks for a multi-asset settlement system pegged to a composite of gold and strategic commodities, with feasibility studies led by Russia's VIEB.RF and the South African Reserve Bank. If implemented, it would represent the first major attempt to bypass fiat-to-fiat conversion altogether. Jim Rickards, a monetary policy analyst and former advisor to the U.S. intelligence community, warned in a Bloomberg interview, If BRICS goes live with a gold-linked trade ledger, the dollar doesn't just lose liquidity, it loses legitimacy. But the real question is whether US trade policy is accelerating that process instead of slowing it down. The 2018 to 2020 US-China trade war added an estimated $57 billion in additional cost to American consumers and reduced GDP growth by 0.3 percentage points annually, according to a 2023 Congressional Budget Office analysis. Despite a 25% tariff on over $250 billion in Chinese goods, the U.S. trade deficit with China widened to $352 billion by 2022, up from $346 billion pre-tariffs. Now, Trump is proposing a 150% blanket tariff on all BRICS exports, including critical commodities like lithium, fertilizer, and rare earths. Economists at Oxford Economics warn this would trigger a cost surge across sectors, with consumer prices projected to jump by 2.2% in the first year of implementation. Meanwhile, retaliatory measures from BRICS could slash U.S. exports by $100 billion, with agriculture, aerospace, and semiconductors most exposed. Former U.S. Trade Representative Michael Froman noted in a March 2025 WSJ interview that tariffs this aggressive risk turning economic policy into a geopolitical liability. But the most dangerous fallout may not be economic, it may be monetary. So if tariffs didn't work against China, why bet on them working against an even bigger bloc? BRICS supplies over 42% of America's imported critical minerals, including 80% of manganese, 60% of niobium, and 75% of battery-grade graphite, according to the U.S. Geological Survey's 2025 data release. Russia alone provides nearly 19% of global fertilizer exports, much of which supplies U.S. agriculture via third-party networks. If tariffs hit these categories, costs won't just rise, they'll cascade. Bloomberg's February 2025 Supply Chain Index shows that a 100% increase in rare earth tariffs could inflate EV production costs by $2,100 per vehicle, while fertilizer price hikes could raise corn and soybean prices by 9% annually. Multinational manufacturers, including Tesla and John Deere, have already issued tariff-related cost guidance for Q2 2025, citing potential supply constraints. The result? Tariffs won't just punish BRICS, they'll penalize U.S. producers more reliant on those raw inputs than Washington publicly admits. But even as costs rise, BRICS nations seem unfazed and may actually benefit from Trump's tariff gamble. Since 2023, BRICS has added 5 new members and now represents 46% of global oil production and 35% of global exports. In contrast, U.S. trade partnerships have contracted, with WTO data showing that Washington's share of global trade fell from 13.8% in 2018 to 11.2% in 2024. While the Biden and Trump administrations diverge on tone, their shared preference for reshoring and tariff escalation has left trade allies like Germany, Turkey, and South Korea diversifying away from U.S. supply chains. According to a 2024 IMF study, intra-BRICS trade rose by 28% over 2 years, while U.S. bilateral trade with major emerging markets shrank by 11%. BRICS isn't just growing, it's coordinating. The 2025 BRICS summit in Moscow featured an agreement on a unified customs digitization system aimed at lowering trade barriers internally while shielding against external tariffs. As U.S. economic policy narrows, BRICS is widening the lane. So who's really being isolated, and who's building the next global trading hub? In March 2025, France's finance minister Bruno Le Maire openly stated that Paris welcomes a multipolar currency system following exploratory talks with BRICS ministers. Meanwhile, the African Continental Free Trade Area signed a preliminary agreement to coordinate digital payments with the BRICS New Development Bank, effectively bypassing the U.S.-dominated SWIFT system in regional trade. Bloomberg reports that Indonesia, which previously maintained dollar-heavy reserves, has increased its Yuan holdings to $38 billion, up from $9 billion in 2020. Even South Korea, a U.S. ally, signed a $10 billion local currency swap line with India in February. According to Credit Suisse analyst Zoltan Pasar, the dollar's dominance isn't dying, it's being diluted by alternative liquidity networks. Washington's influence is no longer guaranteed. It's being negotiated country by country, ledger by ledger. So is BRICS winning global allies, or is the US losing them? While publicly framed as a defense of American industry, Trump's 150% tariff proposal may function as a preemptive strike against monetary decoupling. According to leaked documents reviewed by Reuters, the Treasury Department warned that tariffs could limit the transactional appeal of non-dollar exports, essentially trying to starve BRICS' alternative currency initiatives of scale. However, this logic assumes BRICS needs US markets more than the US needs BRICS resources, a claim challenged by recent IMF modeling, which shows BRICS could sustain internal growth at 5.1% annually, even if Western exports dropped by half. Former Fed Chair Ben Bernanke told CNBC in March that economic nationalism may look strong short-term, but it's strategically fragile in a diversified supply world. If tariffs serve as a tool to protect dollar supremacy, they may do the opposite, by accelerating the very systems they aim to undermine. So, is this strategy a masterstroke, or the final symptom of a system under pressure? We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.